I'm Scarlet Fu. This is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Charles Schwab wants to own the brokerage industries tomorrow with its blockbuster purchase of TD Ameritrade. The next big thing, Presidian's Dan McCabe paves the way for Capital Group and other active fund giants to enter the ETF world on their terms. And should you make this turkey the center of your investment menu? We'll dig into the details in this week's There's an ETF for that. Now, love them or hate them, ETFs are here to stay, and their flows often signal broader market trends. Eric Balchunas, our ETF maestro, walks us through what he sees in this final week of November.
Thank you, Scarlet. And the final week of November is a continuation of just a very risk-on November. And look who's at the top. Remember, 2 weeks ago I said, look for SPY to be on top of the leaderboard very soon, because anytime the risk is on and animal spirits are out, you will see money flow into SPY in billions of dollars. So you have SPY at the top there. No one else is even close. But look who else is on here. You've got junk bonds. You've got that's emerging markets, small cap financials. There you've got Brazil. You're not buying Brazil unless you're feeling pretty good. And then tech, right? So let's look at equities in general, right? This had been the year of the fixed income ETF up until recently. Here's fixed income and equity flows cumulative for the whole year. You can see equity making a late break here. And there's fixed income. That's about a $20 billion gap. They look like they're headed for a clash. But I think the smart money is on equity actually taking more in. And I say this because let's look at December's. December tends to be a very big month for equity ETFs. Here's equity versus fixed income for the last 5 Decembers. And you can see that's an average difference of $35 billion, right? Why does this happen? Usually you have the Santa Claus rally in effect and tax loss harvesting. So you tend to get more flows than normal in December for equities. So Scarlet, if I had bet that fixed income would finish the year ahead of equities, I'd be pretty nervous right about now.
If you had bet, okay, let's put the hypothetical to the test here and bring in our friend Todd Rosenbluth, head of ETF and mutual fund research at CFRA, as well as Andy Massa, who covers asset managers for Bloomberg News. So Eric paints a pretty bullish picture for equities using history. And you two do have a bet where you believe fixed income will keep taking in money and preserve its lead for 2019. So first, are you getting nervous yet? Second, what's going to be the catalyst for this next bout of risk aversion then?
So Eric is basically choosing the New York Yankees to make the playoffs, something that happens year after year, but it is rare when it doesn't, and it's really exciting for the overall industry when it happens. So fixed income ETFs are really punching above their weight. Let's remember, they're 20% of the overall ETF pie. They're gaining in traction from an asset allocation perspective and a tactical perspective. So equity is likely to gather more assets in December, but we still think that there's going to be enough of a gap. It's $20 billion. We still think that's going to hold, and the lunch bet that Eric and I have is going to be in my favor. All
right, well, we have a couple of weeks to see that play out. In the meantime, Annie, I know you've been keeping pretty busy, and the big story that's keeping you busy is Charles Schwab. In general, first of all, it cut its fees to zero. That was last month. Now it's buying TD Ameritrade for $26 billion. James Safer of Bloomberg Intelligence was saying that by cutting fees to zero, Schwab knew exactly what it was doing and drove down the price of its rivals, allowing it to pick up TD Ameritrade at a 25% discount. Clearly, there was a method to Chuck's madness.
Yes, it seems like a tactical move on Schwab's part for sure. First, you had the move to zero commissions, which was something that Schwab thought about for decades. First, in the 1990s, you had the brokerage look at perhaps cutting fees to zero. And then again in the mid-2000s during the financial crisis. So this was something that was in the works for a long time. Schwab had the advantage of having less revenue coming in from brokerage commissions, and it was able to take that plunge and then set itself up for the acquisition after.
Yeah, working from a position of strength here. And Eric, the shift to lower fees has been going on for years, but it really took on urgency of late. Interactive Brokers announcing a new platform for commission-free trades in September. And then, of course, you had Schwab getting rid of commissions in October, others following suit.
Yeah, these kind of fee outbreaks tend to happen in real clusters. Reminds me of the fee expense ratio fee war in early February, where everyone got involved in 6 weeks, and then it was like silent. So, Todd, I ask you this. What's the takeaway here for the investor or the advisor using these platforms and also the industry?
So from an individual investor standpoint, there's probably little change. You'll probably still be able to use both platforms for a long period of time, at least into the next year and beyond, and then they'll slowly migrate as we've historically seen. Advisors, it's perhaps a bigger thing. Schwab and TD Ameritrade are the two large platforms that RIAs use to clear and trade through. They're going to use the scale to be able to get the tools and resources. There's a lot of overlap there, but there's still differences between those. I think the big difference we'll see within the ETF industry is that Charles Schwab is the 5th largest player, but they have the 3rd most inflows this year. And it's what's interesting about their product lineup, broad, diversified, low-cost products. Just one of their products has even a slight net outflow this year. Money is going into their equity and their fixed income products, and that's likely to continue as they get even bigger in this space.
And the combined firm would have almost $2.1 trillion of advisors' assets in custody, which may raise some eyebrows for regulators. You know, Charles Schwab spoke to Bloomberg not so long ago in October before the bid for TD Ameritrade, and he talked about M&A in the industry. Here's what he told us.
I don't know whether we'll be successful in that pursuit, but I think in the industry you're going to see more consolidation, more firms getting together. You just have to have that scale and volume. And so we're prepared to do it if the opportunity arrives, but if not, we're perfectly happy to go it alone.
Going it alone now is Etrade, because TD Ameritrade and Etrade were reportedly in talks before Charles Schwab made its move. Consolidation seems to be inevitable, Annie. Does this mean that we're just going to get 4 or 5 big companies that are vertically integrated and everyone else is kind of left out in the dark?
It's a big question what will happen next, especially with Etrade, because the Schwab TD Ameritrade tie-up was not what was initially really expected. So you've heard people speculating about who might want to come in and buy an Etrade. Would it be a BlackRock or would it be Goldman Sachs? And there's really no indication right now, but Etrade is in a tough competitive position given this merger.
Now, in my opinion, a lot of this is really just a reaction to the V word, Vanguard, right? And if you pull the thread on all these outbreaks, you tend to get to them. They did this commission-free thing a year ago, so you could argue they were the mastermind. And there's a theory that they did it so they could get their ETFs distributed commission-free on all these platforms. What do you think of that?
So Vanguard is the 2nd largest player to iShares, as everybody watching this probably knows. They continue to gather assets. They're on now everybody's platform, and you can buy and trade their ETFs commission-free. They're among the cheapest products. They're among the most liquid products. So I think they've been a beneficiary as we've gone to no commission. We also think that their product lineup, as well as others that have more ultra-short products, where you'll see money market equivalents into products like Mint or JPST or NEAR, some of these products are going to benefit as well, as we have commission-free on all ETFs, on every platform.
All right, but I like the theory that Vanguard started it all. Thank you so much, Todd Rosenbluth of CFRA, and of course to our very own Annie Masso, who covers asset managers. Now, coming up, Presidian Investments CEO Dan McCabe joins us. His company's investment model has been one of the most talked about stories of 2019. Find out why. And one fund that caught our attention this week is BlackRock's Core Euro Corporate Bond ETF, the ticker IEAC. The $15 billion investment-grade credit fund trades in London, and when paired up and matched up against its U.S. counterparts, it tops the list with a record $5.5 billion of inflows this year. A reminder, by the way, that you can find all of our charts on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet. This is Bloomberg ETF IQ. Let's get to the ETF Lifecycle, where we take you through the 3 main stages of the funds. Step 1 is the filing. Exchange Traded Concepts registers a suite of 3 ETFs focusing on U.S. international developed and emerging market stocks. The funds will invest in other ETFs, with the U.S. version rotating between specific sectors, while the international funds will select single country funds. Step 2 is the launch. TD Asset Management has 10 actively managed ETFs trading on Canadian exchanges this week. They range from treasury funds and high-yield bond funds to dividend-focused funds. And for some, the final stage is liquidation. PIMCO will close its 1 to 3-year U.S. Treasury Index ETF on December 12th. TUZ is passively managed and has over $50 million in assets, which is higher than the average for a liquidating fund. Time now to get passive-aggressive, where we track the tensions between active and passive investing. Come January, we could see giant firms with trillions in assets jump into the ETF world with a brand new structure. Joining us now is Presidian Investments CEO Dan McCabe to talk about their non-transparent active. Now, when you look at January as the starting point for your Presidian structure. Is there anything in the plumbing that still needs to be worked out before the launch can take effect?
Well, there are a few, Nate, Scarlet, that we're working out right now with both the CBOE, the New York Stock Exchange, as well as with indicative value providers behind the scenes. But I think that we should be easily able to hit the January launch or definitely within the first quarter.
Okay, got it. Now, you've already got some big asset managers lined up as licensees of the Presidian structure, but others like Fidelity and T. Rowe Price, they've set up their own structure as well. What are the key differences between the structures? In other words, how confused are investors going to be?
Well, one of the things that the advantages that we have that I think some of the other parties don't have is that we've been able to license some of the larger entities that you're talking about. So the JP Morgans, the Goldman Sachs, you go down that list, the American Century, Gabelli, and others. We have about 14 active managers that have licensed from us that have about $15 trillion of management, money under management. So I think the advantage is that we will all be selling the same structure, to your point.
Okay, so I mean, the principle, the underlying principle is the same thing here. One big pushback is that these non-transparent active structures are a solution in search of a problem, or at least a solution for the asset management industry rather than investors themselves. Ben Johnson of Morningstar had a chart that shows the active mutual fund flows for the Presidian licensees, and it's been pretty much down, 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 especially the last 5 or 6 years. Why do you think these guys will have success now with this new structure when they can't get it done with, they're already losing so much money as it is?
Well, I think the reason that they're losing that money is because they haven't had the right vehicle to be able to compete against the passive ETF space, for the last 25 years. So we've seen the flows, to your point, move over to passive vehicles. But for the first time now, you're going to have active management community have the ability to avail themselves of a structure that will give them the same types of tax efficiencies, trading efficiencies that today's ETFs enjoy. So I think now we finally have a level playing field.
One argument that non-transparent active proponents make over the current transparent active that we do have available is that the really good managers haven't really made the shift into the ETF landscape, and this would allow them to, would pave the way for them to do so. My question, though, is who are the really good fund managers these days? Because it feels like the era of star fund managers is over. We no longer have Peter Lynch and Jeff Vinnick picking stocks anymore. Sure, there's Warren Buffett, there's Howard Ward, and there's Howard Marks, and there's Ray Dalio, but they're not really accessible to ordinary investors. Well,
to your point, there are a lot of people out there today that are not accessible. So if you look at potentially JP Morgan or Goldman Sachs, you might not have the ability to access those parties, or even hedge funds managers who you can't access because you don't meet the minimum requirements. These are the kind of vehicles that allow those portfolio managers to come to market and to compete against the standard index-based products. And specifically, you're going to look at performance that they're going to pick up in this model that they're not picking up. And today, we're getting closer to tax season right now. ETFs have a major advantage over the mutual fund complexes out there because of the ability to deliver in-kind securities out and reduce the cash drag. Now we're going to have the active manager be able to avail himself of that same type of structure. Are you getting interest from the hedge fund managers? We are talking to several. And how close are they to doing something? Well, I don't know if they're not going to be the first mover, but I wouldn't be surprised to see people be second movers or third movers. Now, regarding the name, non-transparent active is a bit of a mouthful. It feels kind of clunky. There are a lot of people in your ETF world who are looking to perhaps change the name or come up with different alternatives. Eric conducted a very scientific poll on Twitter, of course, and non-transparent active or active non-transparent, which our Rachel Evans has proposed, was the most popular choice by far, 44%. A majority, though, went in the other direction. They were looking for alternatives. What's your thought on this? Is it wise to find one way of categorizing this product? Right. I feel it is unfair to label them as non-transparent. We don't label a mutual fund as non-transparent. And actually, they have much more transparency in these vehicles because we are fully, in our case, price transparent. Our model allows for actual pricing of the underlying component securities every second of the day. To that point, I like to call them semi-transparent, or we just refer to our structure as active shares. Active shares, right. That's the brand name when it comes down to it. All right. Presidian CEO Dan McCabe, thank you so much for joining us today. Thank you very much for having me. Have a great holiday. Now, coming up, despite all the recent political and military turmoil in Turkey, the country's stocks recently hit a 19-month high. So next, we're going to take a look at the ETF that tracks Turkey.
And for a drill down into all of Bloomberg's ETF content, check out bloomberg.com/markets/ETFs. This is ETF IQ. I'm Scarlet Food. This is ETF IQ. 'Tis the season to shop, and if you're in the market for ETFs that target the retail sector, you are spoiled for choice. Simeon Hyman is here to tell us about ProShares' suite of funds, which range from a focus on online retail to betting on the death of the mall. But before we talk to him, Eric Balchunas is going to give us a drill down into one of the firm's funds, ONLN.
Thank you, Scarlet. Yeah, nothing says the holidays like retail ETFs, like if you're an ETF analyst, I guess. We cover them every single season. This one is a new one. It's an online retail. This is the big new thing, right? So it's a pretty obvious what it does. There's a couple things I need to point out here. First of all, pretty new, 22 million, 58 basis points, a little on the high side. And then the key thing here is the index weighting, market cap. That'll come in handy in 2 seconds. So let's look at the holdings, which is where that market cap weighting is crucial to understand. So you're going to see obviously the big popular companies here because it is market cap weighted. Amazon, Alibaba, right, Shutterstock, eBay, pretty much companies we all love and know, but look at the weightings. 24% in Amazon, 13% in Alibaba. Those two stocks are really driving the car here. In fact, they're responsible for over half of the performance of this thing since it came out. Now let's look at it versus its competitor, iBuy. And the big difference is, again, the weighting. ONLN is going to market cap weight, so look, Amazon, Alibaba, massive. And then this one's going to equal weight, right? So see these two companies, everything's about a 3% weighting in there. So, and this one has a little more, this is more concentrated. So at the end of the day, Scarlett, look, you're going to basically be betting on Amazon and Alibaba. If you don't are bullish on those companies, then the other one will be the right choice. The weighting is key here.
It all comes down to looking underneath the hood. Now, still with me is ProShares global investment strategist Simeon Hyman. Simeon, retail stocks, retail ETFs get a lot of attention this time of the year, but they don't necessarily outperform at this time as well because we all know a sales bump is coming. It's pretty much priced in. So when do you position for a run-up in retail companies?
Well, this year we have a very short season, so we all know Thanksgiving's very late. You'll note, I've seen you guys talk about it, XRT, the big shorted retail ETF. There's been a run-up in some of the legacy brick-and-mortar players who've had some decent times this year, but we're up against some good expectations. The good part is, for those who want to be bulls, last year was tougher. Remember, we had an equity market sell-off. The Fed was on the wrong foot. Lots of headwinds that aren't really there this year. The consumer's in a pretty good place.
And then let's talk about clicks. So ONLN is long only, plain vanilla. Then clicks basically goes short the brick and mortar. So talk about the influence of XRT. XRT is highly famous for being shorted, like 300% of its shares are shorted. And the trade had been long Amazon, short XRT. That was the death of the mall trade. Is clicks, was it inspired by that? Is that sort of what you're trying to make easy?
Yeah, that's definitely the package theory here. And, the key here is that XRT is all bundled together. In other words, the online and the brick and mortar folks are all in that index together. So if you look at performance year to date, so we have our online store index, which is what ONLN follows, and then we have our brick and mortar index, which is the short leg of CLIX, which is 100 cents long, the online folks, and 50 cents short, the brick and mortar folks. If you look year to date, the online index is up mid-teens, 13, 14, 15%. The brick and mortar side is roughly flat. XRT is sitting in the middle. So if you want to split them up, because it's very clear that the prospects are very different for the two, we think we've given a very surgical solution for that.
So ONLN and clicks are both thematic ETFs. They make sense to people. It mirrors what's happening in the world around us. How big a factor, how important is the narrative or the story you tell when it comes to pitching and selling the idea of a thematic ETF?
Most thematic ETFs have an idea that resonates viscerally with folks. So what you've got to do is you've got to explain to them what was the logic that made that into an investable idea. And Eric hit on a very important point. We thought that on the online side, market cap weighting was important. Scale is everything. But on the short side, on the brick and mortar side, we actually equally weighted it. So you might have been surprised. Some of the viewers might be surprised to hear that the brick and mortar index is roughly flat this year, because all you hear is that Best Buy, Target, and Walmart have all done well. But if you look on average on an equally weighted basis, the roadkill's all over the place. Kohl's, Children's Place, Macy's, you just keep going down the list.
And speaking of your theme ETFs, pause, got to cover this. It hasn't done a great job. It's trailing the market by like 15% since it came out, but it's got 50 million.
And it's got a great story.
Yeah, is that the story selling? Just talk about when you talk to advisors about the pet care industry.
So it's back to the story is almost irrefutable. I mean, we know there's more pets than children, and everybody's spending all this money, premiumization, and it's $20,000 for a new knee for your dog or a hip. All these things people know. How do you make it investable? And, you know, our focus was making sure there were enough pure plays out there, which there are. You know, the Chewies, the Elanco's, and having a small representation of the conglomerates like the Smuckers of the world. So we did it right. We put the construction together. If you look at performance, one thing that I think is really important, a little over 50% of this ETF is pet health care. You know what there isn't? There is no Medicare or Medicaid for dogs. And if you look at the performance against the healthcare index, you'll see when that healthcare index takes a hit because everyone's talking about Medicaid for all, you'll see outperformance from the pet care ETF.
Simeon Hyman of ProShares making the case for pause and for online retail. Thank you so much.
Thanks so much.
Now, we like to say that the ETF industry has something for everyone, including those who believe more risk leads to more reward. Congress, we know, may threaten to impose sanctions on Turkey, but it hasn't hurt returns in the past month. Check out this week's There's an ETF for That. The iShares MSCI Turkey ETF is the largest fund to track Turkish equities and trades under the ticker TUR. Despite recent military and political tensions in the country, its performance has held up. TUR has returned roughly 10% in 2019. Flows took a hit at the start of the year and through the summer, but have started recovering of late. TUR has some $360 million in assets and an expense ratio of 59 basis points. The fund holds about 50 companies, weighted by market cap. Names include Garanti, Akbank, BIM, and Coach. The allocations lean heavier to the financial, industrial, and commodity sectors. Looking at TUR's long-term performance, the fund has been in the red since launching in 2008, losing almost 30% and trailing the broader MSCI Emerging Market Index. This year, though, TUR has been able to keep pace. TUR gets a green light in the Bloomberg Intelligence traffic light system, but there is a warning for potential discount premium issues because of the nature of the underlying market, which can be exacerbated by differing market hours from the U.S. Single country ETFs is a good story, but usually investors get their exposure through an EM fund.
Yeah, in Turkey's case, it's probably a good reason to do it because it's not a big weighting in the EM fund. But otherwise,
Unlike
yeah.
China, right?
Yeah, exactly.
All right, that does it for ETF IQ. See you next week. This is Bloomberg.